Hello Forex winners. In this video we will talk about practical trend trading. Let's start. So, why trend trading? So why should we focus on trend trading instead of range, counter trend trading? The short answer is that a trend trading strategy is most likely to be the optimal one for retail traders. You see, it boils down to how the retail trading industry is structured. To succeed in any game, of which retail trading can be considered to be one, we'll first have to study the rules and their implications for the players involved. Imagine a coin toss game where there's an equal chance for the coin to land on either side. In this game, we can either double our stake if we bet on the winning side, or lose our stake if we bet on the losing side. In a game like this, we should probably choose not to play at all, since the profit expectation in the long run would be zero. This is often referred to as a zero-sum game, where every $1 lost by a player is won by another player. However, this is not how retail trading is structured. Instead, it's a lot more like a card game at the casino, where the house takes a cut out of every game that's played. This results in a different dynamic compared to the coin toss game, with the overall expectation here being negative, that is to say, that every $1 lost by a player results in only a gain of 90 cents to another player, with 10 cents going to the broker/dealer. So, as retail traders, the first thing we have to be aware of is that the average profit expectation of the trading game is less than $0. That is worse than betting on a coin toss. And we'd also have to consider that the professional, institutional traders in the market are faster, more well-informed, and have a lot more capital to trade with than we do. This puts us at a significant disadvantage, and everything else being equal, we'd probably get our asses kicked if we compete directly against them. So even though our average profit expectation is less than $0, statistically speaking, in practice it is probably a lot lower than $0. At this point, you might be starting to feel a little discouraged about this whole trading business. If so, you're on the right track. The reality is that retail traders tend to lose money because the industry is structured with the odds stacked against us. It's really that simple. And this isn't even considering our tendency to self-sabotage by entering and exiting trades at exactly the wrong times, due to psychological biases. A quantitative trading approach benefits the party that has the odds in his favor. For example, a casino has an approximate 3.5% advantage, positive expectation, over the players at the blackjack tables. With this statistical advantage, the main incentive of the casino is to get as many people to gamble as often as possible. The casino owner doesn't care whether the house wins or loses at each round of blackjack, because he knows that the more people gamble, the more money he'll make over time. This is also how trading brokers, market makers, operate. By charging a spread fee, they essentially tilt the odds of making a profit in their favor, and are incentivized to get their customers, retail traders, to trade as often as possible. See you in the next video.